Portfolio Builder members, today's trade alert is to buy to close our May 29th 281.50 SPY covered call. Should cost you only a few cents, so almost 100% profit on the covered call. And then to sell to open, one contract per 100 shares of the SPY, the May 31st 275 covered call, potential $83 profit per contract. And we have $4 of protection to the downside, which is great. This means if the stock market goes up, flat, or down up to $4.22, we cannot lose money. And if we go flat, we may make more profit than the so-called baked into the cake $83. So if we make $50 3 times a week, 52 weeks a year, that compounds into a 35% annualized return. Normally, we have to sell covered calls out of the money and essentially have downside risk to accomplish that. But today, because volatility has spiked and the S&P 500 has a very rare 2% correction overnight from yesterday's high till today's low, this gives us the opportunity to sell a covered call and have downside protection, but not lose money if the market goes higher. So this is a great setup. This is ideal for our program. And we're also recommending that you own per 100 shares of the SPY, one July 19, 2019, 264 put option on the SPY. So this helps us protect against a serious flash crash. And if the SPY were to get to the 264 level, this will likely rise to anywhere from $10 to $20, depending on how much lower below 264 we go. So we want to hold on to one of these per 100 shares of the SPY we own. You can see the open interest is piling up at the 275, at the 276 and 275 level. There's just under 80,000 contracts sitting there to purchase the SPY ETF. So that's why we chose that 275. I would rather go with a out of the money 281.50 strike. But because there's such an existential threat to the markets right now, with the trade war escalating, this is a good time to play it safe, to add more downside protection, and to be able to sleep safe at night. So yesterday, the SPY opened at 284. It hit 278 this morning. That's over a 2% drop in value. And our portfolio went from 6.5 to 5.95. And as we write these covered calls, you'll see the profits jump right back. So I've now inserted the new trade. You can see the profit we took down here, 98% profit. And again, you got to remember, if we take a big profit on the covered call, then you got to be worried what happened to the underlying asset. Now, of course, we love the SPY. The S&P 500 is something we want to own for the rest of our lives, and we want to rent it out to speculators. But of course, when we have downside volatility like this, it really wakes you up to the risks you have when you just outright own stocks. And that's why our strategy is so much better. We have downside protection and still generate profits when the market goes up. So you'll watch as the more volatile the stock market gets, the better this strategy becomes, because the prices of options skyrocket. So let's just take a look at what happened. Everybody else lost at least 2% from yesterday till today. We lost 0.5%, and you'll see, because we can write the covered call, we now have downside protection and an $86 potential profit if the market goes higher. So as you can see, that's a potential profit of at least 0.31%. And so just to show you the power of doing this over and over again, if we're able to make a 31 basis point or a 0.31% return 3 times a week, 52 weeks a year, $30,000 compounds into $48,620. That's a 62% annualized return. Now that assumes no losses. Of course, we are going to have a few losses here and there, but I think you get to see the illustration of how quickly we can protect our portfolio and grow the profits back as volatility increases. So normally we'd have to have a very risky trade to get anywhere near this sort of potential profit. We'd have to sell the covered call above the trading price. But during times of volatility, as long as you're not greedy, see, we could have sold the 281.50 for the same credit and then also had a huge upside potential. But instead, we're playing it safe. And so while we're agreeing to a loss on the underlying ETF, which we'll look at right here, we're agreeing to sell our shares for $275, which is $3.39 below its current value. So why would we do that? Because the option speculator wants to pay us $4.22. So if we're correct and the market continues to pull back, we have $4.22 of insurance. Now, if the market travels higher and the speculator's right, we still make that $86 profit. And in fact, if the market just goes flat, we'll make even more money, because as the volatility dies down, the cost for us to buy back our covered call will be less by Friday. Now, what we're going to do tomorrow if the market does teeter lower towards the 275 strike or even lower? Very simple. We will buy back the covered call and write a new one at a lower strike price. And so eventually the volatility does die down and the asset either flatlines or goes back up. And that's when the profits really, really roll into our account. So that's our trade alert today. I do have a second video coming out daily now, which will cover all the charts, all the news, all the important links to study, and a detailed overview of all of our different trading platforms, including the basic membership, which trades the SPY ETF, our high yield program, which is trading the underlying assets that the SPY ETF purchases, and our whale program, which has been sitting pretty on the TLT, as the TLT now has broken to 129.57, which is just absolutely insane. So this whale club has been doing very well just trading the TLT. Our Diamond Club is doing very well trading Microsoft, Apple, Facebook, Intel, Cisco, Comcast, Bank of America, and Wells Fargo. And meanwhile, our basic program has been exclusively trading the SPY in 2019. So look forward to the new video coming out after that. And here's one last recap of how to follow this trade alert. Step 1 is to purchase lots of 100 shares of the SPY. If you're brand new, you'll skip step 2 because you didn't write this covered call. So you can go straight to step 3. Per 100 shares of SPY you own, you also want to go to the sniper hedge, which is, again, to summarize, to protect for the short term, we do the sell to open May 31st, 275 call, 1 contract per 100 shares of the SPY you own. This protects you down to the 275 level, but if the market travels higher or flat, we also win. So it gives us a huge variety of potential outcomes in the S&P 500 for us to win between now and Friday. This is the July 19th 264 put option, and this really protects us if the SPY goes to 264 and then goes below that. So this is more of a long-term hedge. It gives up some of our profits, but it's really our insurance. And if tomorrow we are anywhere near the 275 strike, expect an emergency alert, same time, where we're going to buy back this covered call and sell to open a new one at a lower strike. This helps us protect and profit during times of volatility and carefully grow our portfolio. So thanks again for your time, and looking forward to the next video coming out in a few hours.